Welcome to section one on warehouse risk. This is the most single important concept in the entire algorithmic system evaluation. And there's a really important reason. One is that by the time you get through section one, you're going to be able to identify 70 to 80% of all algorithms on the market quickly, okay, in 5 minutes. So this is extremely important. And it's the most dangerous type of risk. That's why we're going to cover it first. And I want to get right into it. So the familiar page, right? You guys have seen this kind of page before. It's everywhere. If you've gotten to this course, you know that you've seen a lot of different ads, a lot of different systems. And this is what you've probably seen a dozen times. And that is this extremely smooth equity curve, super smooth. This is probably doing it an injustice how bumpy this one is. It's just a graphic, but the huge returns, the minimal drawdowns, the super consistent results every month, the high win rates, and all of that stuff. And this is pretty much the picture that you guys see. And this picture is something that I want you to immediately learn to recognize as, hey, very interesting, and I need to put on a lens here. I need to put on my goggles and do some work because what you're about to see is that is the most dangerous picture in all of algorithmic trading. Okay. And there's a reason. So, what I'm going to do in this section is pretty much dismantle piece by piece. All right. 5 really important things. Okay. One is the hidden mechanic. Okay. The industry term for this single mechanic that hides underneath all of these smooth equity curves and how it manufactures these perfectly looking smooth balance lines. Okay. So there's 4 detection tools that we'll get right into too that will expose this mechanic, all right, from 4 different angles so you can never miss it. It's going to be completely obvious to you. It's not going to be something you're confused by anymore. It's not even going to be something that you consider after we're done. All right, the drawdown deception on these systems is going to be exposed as well. All right, a system can say they have 5% drawdown and actually have 40, 50, 80% drawdown or worse. And I'm going to share with you a single question that reveals how you can figure this out in literally 2 minutes. All right, so the evidence legitimacy. So why a system with real drawdowns and real variance is actually showing you the most important evidence that it's not legitimate, okay? And then finally, a nice fingerprint, all right, what this 72% win rate trap is. And by the time we're done with this, I promise you'll have a whole new perspective. Life is going to get a lot easier, and we're going to keep your capital safe. So, what is warehouse risk? Okay, what's this concept? Okay, so let's talk about 2 paths. Excuse me, path A and path B. All right, path A is what professional systems do. It's very clean. It's very simple. When a system is losing a trade and decides that loss, it knows it's wrong, it takes the loss. It has a defined loss and it just takes it. Okay, it's very simple. Warehousing risk is when systems hold positions, add positions, and wait for that recovery. Okay. They hope it comes back. So as a losing entry is developed, it is storing and adding to these losses, waiting for the price action to recover. All right. The exposure is growing. This bill is accumulating. All right, we're going to talk about this bill. It's warehousing this risk. So, what does it really look like? And I'm going to show you on the next slide something that some of you probably have nightmares about because you may have experienced this before. Hopefully, you have not. And on the next slide, it'll be completely new for you. Okay. So, this is actually the mechanism, what warehousing looks like on a chart. So when you have positions, and some of you are familiar with trading, it doesn't matter if you are or not. You don't need to be extremely familiar with this. Okay, the concept is pretty simple. As you are in a position, the first entry happens, and if it goes against you, what a grid or a Martingale system does is add to that position and reduce the average, and it continues to do that, reducing the average. The other thing that it does is that it builds heavier and heavier positions so that it can drag that average down. Okay. So as you're in your first entry now, back here, now the price continues to move against you. And if it does that, the system is going to continue to add, but heavier and heavier weighted positions. Okay. So now you're at a much deeper exposure and you're way below. Okay. You're way below your average. finally, the system will continue to do that infinitely until the price action starts to retrace a little bit. Eventually, if it retraces enough, you will take a small profit when it gets above the average. This is what generates these smooth equity curves. And I don't need you to get too technical with it. I just want you to understand this is what it looks like, and you will see that on your whether you're watching it on your charts or not. These positions will accumulate. You'll have 10, 20, sometimes 30, 50. I've seen a system up over 100. Okay, it's nuts. And it gets extremely heavy. All right, so we're going to talk about this. And this is exactly what happened to Steven. Okay, the bounce never came, and he ran out of capital before the bounce happened. And that's why, if you've experienced it before, you know that's how your account blew up, or that's how you took a major loss. And if you haven't experienced it, I'm going to show you how to avoid this, never have to deal with it. But this is what it looks like, okay? So, what happens with that beautiful little chart, right? So, we have this beautiful balance chart, the huge returns. What is happening behind the scenes is really important. So I just showed you on a chart the actual mechanism looks like. This is what happens, you guys see on the balance. Everything looks like a win, because as you build these positions, you never take this loss. You never realize the loss. And we talk about unrealized and realized losses a lot. So you never realize any losses. Okay. You're just holding positions. And as the system just accumulates wins, and it looks all good. But the real hidden risk is the distance. And we're going to talk about this a lot in the next module. Okay. The hidden risk here is the distance between the balance line and the equity line. Okay. And the actual exposure can be huge. So even though this has a super smooth and it looks all sexy, it's extremely risky. It's extremely dangerous. It is not a real system. Okay. Now, I know I'm blowing some of your minds potentially with like, oh, what do you mean it's not a real system? I will explain more. This course is not about saying again that you can't find real systems. This particular situation is definitely one of those where this is not a legitimate system, because it's warehousing way too much risk, and that ends up putting your account in your capital into extremely it's almost guaranteed that you will lose your account, because eventually a price will move against you too much, okay, before you have enough capital to survive this bounce, okay? And that's why these systems can work for quite a while. So why is it so dangerous, guys? I think one of the things that I want to get into is that there is a psychological part of this, okay? The phases that anyone go through like Steven did is very simple. One is, you guys, we all do this, right? We want to test the system. We start small, right? We start or we start at a reasonable level that we want to generate comfort, right? And so the risk is always still present, but what happens is these systems can run for quite a while without destroying your account. So as the performance goes, right, you end up adding capital, right? Like Steven did. So, hey, this is working really well. I want to add a capital. And now your account's growing as well. And now your account is still performing and your confidence is building. So the risk is always there, but your exposure to it grows dangerously because the confidence that you have in the system grows. And that confidence is misplaced. And that's what we're going to show you. And I'm going to describe all this. We're going to go through it. And what happened with Steven is that he ended up not only growing his account, these are values that Steven had added to the account, not the growth. So he had almost $1 million in this account. I think it was like 800 something thousand dollars by the time phase 4 happened, which was his crushing blow up, all of his account. But this was his core capital, the capital that he didn't even get a return on. He lost $400,000 just of his own money, 800 something thousand dollars total in the market. Okay. But that risk was always there. And the danger is the confidence trap is real. It will kind of boil you like a frog, right? Slowly. And the one thing I do want to note is that you could blow up your account on day one. Some people join these systems, right? And they literally join it on the wrong week, and they never have any of that. So it can happen anytime, but likely it only happens once every year or two, once every 6 months or so. And therefore, it allows you to get confident with the system, unfortunately, and you can really get a lot of capital destroyed. So let's talk about the other form of warehousing risk. Okay, there's many forms. That's the most popular, the Martingale grid system. It's very simple. The one thing I can tell you too is, please, when you guys come to recognizing this, do not buy any of those systems. Okay, I will give you them for free. We can build them in 5 minutes. We can build. We've explored for fun having like a weekend sprint for coding, and we've built systems as our team. And we've explored, that for fun to see who can build the most sophisticated one. And look, do not buy those. Do not spend $10,000, $20,000 on one of these systems. And do not use them. But if you need to look at them and you want me to show you, I will provide you one for free. Okay. So there's that, right? There's also broad warehousing, which is unsystematic. So it doesn't grid. It doesn't do that. Everyone who's been a trader, okay, has been susceptible to broad warehousing. And the number one thing that broad warehousing kind of looks like is just buying and holding a position way too long, hoping it comes back. Okay. In a way, you are warehousing risk. Okay. So there's all those two spectrums. All right. So there's the extraordinarily ridiculous and risky way to warehouse risk. And then there's warehousing risk in a broad, all the way to the simplest version, which is we've all been there. Even in my early days in trading, where you're kind of like, well, I think it'll come back, so I just hold it a little bit longer than I want to. Okay, all of that is still counting. The bill is still accumulating, and the bill is going to come. Okay, and I just want to point that out. So there's multiple ways. We'll look at some other ways that are like pseudo, not this bad, but in between. Okay, so we're going to look at everything. It's going to be really interesting, and you'll learn a lot. All right, so basically, like I've explained this already, Steven's story, but I do want to iterate this one more time, guys. There's so much at risk here. It's so important the next couple of sections in this module that you really pay attention. I promise you, this module will save some of you hundreds of thousands of dollars. I'm not joking. I really am passionate about this subject. It's probably the most ridiculous form of the algo space out there. And I am on a mission to save people from this experience, because I have met so many people that have done it. Okay. I know some of you already know a lot about this system. Skip to the parts where we talk about how to identify it real quickly. That's totally fine, but don't skip it the whole thing. Even if you've been experienced this, you need to recognize it in all of its little forms, because they can still fool you. All right. So professional nuance here. Okay. So we are, some of you guys know me. Some of you are familiar with me. Some of you might have looked me up. And our team does professional stuff. So we have to always kind of do the professional nuance, right? Is there such a thing as averaging, or is there such a thing as pyramiding? Is there such a thing as having multiple positions that create a position? Yes, that is a professional thing. Okay. You can do that. What happens is there's a spectrum. Okay. Generally, a soft rule is 2 or 3 positions is the extent of that. That's what that looks like. It very rarely professionally gets any deeper than that. Okay. So there's a spectrum here, not 10, 20, 30, 50, 100. That is not professional. There is nothing about that. I've never met any of my professional colleagues that build stuff like this, that do that. We've never done it. So just know there's a professional nuance. If you see a system that does do 2 or 3 positions to create a position or create an average when it feels necessary, and it's building a position, whether that's on the upside or down, that's not necessarily the same thing as saying it's unprofessional. Okay. All right. So basically what we're going to do next is, what warehousing risk looks like and is, but now we need to figure out how to detect it, right? We want to know what are the things that we specifically that specifically can look for, and how we can quickly do this in literally 2 minutes, 20 minutes max. Even if you don't have any skill in the market, even if you never looked at anything before, I promise you, this will make it extremely easy and simple, and we'll walk all the way through it. So definitely don't skip the next part, guys. We're going to get right into how we detect this and how I can keep your capital safe.